My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject International Financial Management as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 5 first important short question is: what is FDI? Foreign direct investment means when a company or individual from one country invests money directly into a business in another country. This is not just buying shares, but setting up or buying a significant part of a company to control it. Why is FDI important? FDI brings money, technology, and jobs to the host country. It helps grow the economy and improves skills. Example: imagine a US company opens a factory in India. The money they spend to build the factory and run the business in India is FDI. They control the factory and get profits from it. Types of FDI: greenfield investment, building new facilities. Mergers and acquisitions, buying existing companies. Easy way to remember: FDI is equal to foreign company invests directly in business here. It's like planting a seed in a foreign land and growing a business tree, helping both countries grow. Next important short question is: 2. What is international capital budgeting? It is the process of planning and deciding whether to invest money in projects located in other countries. Companies use this to check if the foreign investment will be profitable. Why is it important? Investing abroad means dealing with different currencies, laws, taxes, and risks. So, careful calculation helps avoid losses and ensures good returns. How does it work? Companies estimate the future cash inflows, money coming in, and outflows, money going out, from the project. They consider currency exchange rates, political risks, taxes, and inflation. Then, they calculate the project's net present value, NPV, or internal rate of return, IRR, to decide if the investment is worthwhile. Example: an Indian company wants to build a factory in the USA. It calculates costs in dollars, estimates sales, adjusts for currency changes, and sees if profits cover the investment. Easy way to remember: international capital budgeting is equal to smart money planning for business abroad. It helps companies pick the best foreign projects to grow safely. Next important short question is: 3. What is international financing? International financing means raising money from foreign sources to fund business needs like expansion, buying equipment, or setting up offices in other countries. Example: if Tata Motors wants to start a plant in the UK, it may borrow money from a UK bank or issue Eurobonds. This is international financing, getting funds from outside India. Why use international financing? Lower interest rates abroad. Larger capital availability. Match currency with expenses. Example: borrow in dollars if spending in dollars. Types: 1. Equity financing, selling shares to foreign investors. 2. Bond financing, issuing international bonds. 3. External commercial borrowings, ECBs, foreign loans. 4. Loans from World Bank, IMF. Risks: currency risk, political or legal issues. Easy tip: raise money globally, grow business globally. In short, international financing helps businesses grow worldwide by using smarter and cheaper funding options from abroad. Next important short question is: 4. What is equity in international finance? Equity means raising money by selling ownership, shares, of a company to investors. In international finance, companies raise equity from foreign investors or by listing on foreign stock exchanges. Example: if Infosys sells shares to investors in the USA by listing on the New York Stock Exchange, NYSE, it's using international equity financing. The company gets dollars, and investors get a part of the company's ownership. Why use equity? No repayment like loans. No interest burden. Brings in foreign capital for expansion. Helps build a global brand and trust. Risks: company has to share control with foreign shareholders. Profits are shared as dividends. Easy tip: sell a piece, grow in peace. You sell a small part of your company to grow without borrowing. In short, equity is a smart way to raise money internationally without taking loans, while giving investors a share in your success. Next important short question is: 5. What is bond financing? Bond financing means a company raises money by issuing bonds, a type of loan, to investors. In international finance, these bonds are sold in foreign markets to raise foreign currency. Example: if Reliance Industries wants to raise $500 million, it can issue Eurobonds to international investors. These investors lend money and get interest. After a fixed time, Reliance repays the money. Why use bond financing? Helps raise large amounts of money. Lower interest rates abroad. No ownership is given up, unlike equity. Useful for funding global expansion. Types: Eurobonds issued in a currency not native to the country. Foreign bonds issued in a foreign country, in that country's currency. Risks: must repay with interest. Affects company if exchange rates change. Easy tip: issue bonds abroad, grow your business abroad. In short, bond financing is a useful way to borrow money from global markets without giving up ownership. Next unit, 5. Long questions. First important long question is: international capital structure and cost of capital. What is capital structure? Capital structure means how a company chooses to finance its operations by using equity, shares, debt, loans, bonds, or a mix of both. In international capital structure, companies need to decide how to raise funds for global operations in different countries and currencies. What is cost of capital? Cost of capital is the cost a company pays to get funds, whether from shareholders, equity, or lenders, debt. It tells the company how much return it must earn to satisfy investors. Example: suppose Infosys wants to open an office in the USA. It has two choices. 1. Raise money from Indian banks at 10% interest. 2. Raise money in the US at 6% interest. It may prefer US financing due to the lower cost of capital and currency match, since the project is in the US. Factors affecting international capital structure. 1. Interest rates, lower in developed countries. 2. Tax laws, some countries give tax benefits on debt. 3. Currency risk, borrowing in foreign currency can be risky if exchange rates change. 4. Political risk, investors want higher returns from risky countries. 5. Availability of funds, easier in some global markets. Importance in international finance. Helps minimize overall cost of funds. Balances risk and return. Supports global expansion. Keeps shareholder value high. Easy tip to remember: smart mix of debt and equity worldwide is equal to lower cost, higher growth. In simple words, International capital structure is about choosing the best mix of loans and shares to raise money for global business. The cost of capital helps decide if a project is worth it. Companies try to lower their cost of funds and manage risks by choosing the right source, country, and currency for financing. Next important long question is: 2. International portfolio management. What is international portfolio management? International portfolio management means investing in financial assets like shares, bonds, mutual funds of different countries to get higher returns and reduce risk. Instead of putting all your money in Indian companies, you diversify your investments globally, like buying Apple shares in the USA, Nestle in Switzerland, or bonds in Germany. Why do it? The main goals are: earn better returns, lower the risk. If one country's market falls, others may still grow, take advantage of global growth. Example: imagine you invest 10,000 rupees only in Indian stocks. If the Indian market crashes, you lose. Now imagine you split 4,000 rupees in Indian stocks, 3,000 rupees in US stocks, 3,000 rupees in European bonds. Even if India's market goes down, your other investments may still perform well. That's the power of international diversification. Key features: 1. Diversification, spread investments across countries and sectors. 2. Currency advantage, gain from exchange rate changes, example, rupee falls, dollar investment rises. 3. Better opportunities, some foreign markets grow faster than India's. 4. Hedge against local risks like inflation, interest rate hikes, or political instability. Risks to watch: currency risk, exchange rate fluctuations can reduce returns. Political risk, unstable foreign governments can affect markets. Legal regulatory differences, each country has different rules. Tools used: mutual funds or ETFs with global exposure. Hedging techniques to reduce currency risk. Performance analysis of international assets. Easy tip to remember: don't put all your eggs in one country's basket. In simple words, international portfolio management helps investors and companies grow money safely by investing in different countries. It lowers risk, improves returns, and protects against market shocks. It's like a global safety net for your investments. Next important long question is: 3. Payment methods of international trade. What are payment methods in international trade? When companies buy or sell goods internationally, they need safe and reliable ways to pay and receive money. These ways are called payment methods of international trade. Choosing the right method helps both exporters and importers reduce risks, avoid delays, and build trust. Common payment methods: 1. Advance payment, prepayment. Importer pays before goods are shipped. Safe for exporter but risky for importer. Example: a buyer in India pays an American seller first, then gets the goods. 2. Open account. Exporter ships goods, and importer pays after receiving. Risky for exporter but helps importer with cash flow. 3. Documentary collection. Banks help collect payment against shipping documents. 2 types. Documents against payment. DP: importer pays first to get goods. Documents against acceptance. DA: importer accepts a draft promising to pay later. 4. Letter of credit, LC. A bank guarantee that importer's bank will pay exporter after terms are met. Very safe and widely used. Example: An Indian importer's bank promises to pay an exporter in Germany after shipping documents are verified. 5. Consignment. Exporter ships goods, but payment is made only after goods are sold by the importer. High risk for exporter. Example. Suppose an Indian company imports machinery from Germany. They might use a letter of credit to ensure the German exporter gets paid only after sending proper documents proving shipment. This protects both parties. Easy tip to remember. Pay smart, trade safe. In simple words, payment methods in international trade help buyers and sellers pay money safely and on time. From paying upfront to using bank guarantees, these methods balance risk and trust so global trade flows smoothly. Next important long question is 4 recent amendments in EXIM policy. What is EXIM policy? The EXIM policy, Export-Import Policy, governs how India conducts international trade. It sets rules for exporting and importing goods and services, aiming to boost exports, simplify processes, and enhance India's global trade presence. Recent amendments in EXIM policy. 1. Streamlining export documentation. Unified declaration. Exporters can now submit a single export declaration form, EDF, for similar services, like software, exported to multiple recipients, up to 1 lakh rupees per invoice. This reduces paperwork and speeds up the process. Simplified reporting. The requirement to credit export proceeds to the exporter's bank account only after filing the EDF has been removed. Additionally, submission of EDF separately is no longer required if a declaration to report the exports has already been submitted as part of the shipping bill. 2. Export realization period. The export realization period for goods sent to warehouse outside India has been extended to 9 months from the sale date, up from the previous 15 months from the date of shipment. This provides exporters with more flexibility in completing transactions. 3. Exporter compliance measures. Exporters with unrealized proceeds exceeding 25 crores rupees for more than 2 years must secure further exports solely against full advance or an irrevocable letter of credit. This ensures timely receipt of payments and reduces financial risks. 4. Project exporters' investment flexibility. Project exporters are now permitted to invest temporary cash surpluses in short-term instruments outside India, such as treasury bills and deposits with banks outside India, subject to monitoring by an authorized dealer, AD, bank. This allows exporters to earn returns on idle funds while awaiting project completion. 5. Enhancing trade facilitation. The Reserve Bank of India, RBI, has introduced the Platform for Regulatory Application, Validation and Approvals, PRAVA, an online portal to streamline regulatory approvals. This digital platform aims to reduce delays and enhance transparency in the approval process. Easy tip to remember. Simplified rules, faster trade, global growth. These amendments aim to make international trade smoother, faster, and more secure for Indian exporters, aligning with global standards and enhancing India's competitiveness in the global market. Next important long question is 5. A US multinational is planning to set up a subsidiary in India. The initial project cost is estimated to be $10 million. The working capital requirement would be 2 million rupees. The project is to generate a cash inflow of 7 million rupees year in first 3 years, and then a growth of 5% per year is expected up to the 8th year. Thereafter, there will be a decline of 7% in growth per year, and the project will be closed down at the end of 12 years. consider a discount factor of 12% and depreciation of rupee against dollar at the rate of 1% per year. Is the project worthwhile? Tax rate in India is 40%. Sure. Let's break this question down step by step. Problem summary. Initial project cost is equal to 10 million US dollars. Working capital is equal to 2 million rupees. Cash inflow is equal to 7 million rupees per year for first 3 years. Growth of cash inflow is equal to 5% per year for years 4 to 8. Decline of cash inflow is equal to 7% per year for years 9 to 12. Discount rate is equal to 12% per year. Rupee depreciates 1% per year versus USD. Tax rate is equal to 40%. Project ends after 12 years. Step 1. Convert initial investment to rupees. Assuming exchange rate is equal to 70 rupees per USD, example, as it's not given. Initial cost in rupees is equal to 10 million times 70 is equal to 700 million rupees. Add working capital is equal to 2 million rupees. Total initial outflow is equal to 702 million rupees. Step 2. Calculate cash inflows after tax. First 3 years, 7 million rupees per year. After tax cash inflow is equal to 7 million times 0.4 is equal to 4.2 million rupees per year. Step 3. Cash inflow for years 4 to 8, growing at 5% per year. Year 4 inflow is equal to 4.2 million times 1.05 is equal to 4.41 million. Year 5 inflow is equal to 4.41 times 1.05 is equal to 4.63 million. And so on up to year 8. Step 4. Cash inflow for years 9 to 12, declining at 7% per year. From year 9, reduce cash inflow by 7% every year. Step 5. Adjust for rupee depreciation. Since rupee loses 1% value per year, cash inflows in rupees terms reduce by 1% every year. Multiply each year's cash inflow by 0.01 year to adjust. Step 6. Calculate present value, PV. Use discount factor of 12%. Discount each year's adjusted cash inflow by 1.12 year. Step 7. Add PV of all inflows, years 1 to 12. Calculate total present value of inflows. Step 8. Compare PV of inflows with initial cost, 702 million rupees. If PV of inflows initial cost, project is worthwhile. If less, project should be rejected. Easy tip to remember. Calculate after-tax cash inflows. Adjust for growth decline and currency depreciation. Discount all cash flows to present value. Compare with initial investment to decide. This method helps companies decide if investing in a project overseas is profitable or not by carefully estimating cash flows, taxes, currency changes, and risks.